video it's going through S5-6. So I want you to practice this on your own. If you haven't done it yet on your own, please pause, try it first, and then once you've tried it, come look at this video. So S5-6 says refer to the Toys Plus situation in S5-5 and journalize the following transactions on the books. So S5-5 says suppose that Toys Plus uses the perpetual inventory system and buys $100,000 of Lego toys on credit terms of 2/15 net 45. Some of the goods are damaged in shipment, so Toys Plus returns $12,500 of the merchandise to Lego. So we're going to do S5-6, which is the journal entries. The first one that we need to do is record the purchase of goods on July 8th. So they purchased these goods for $100,000. So we record the purchase at the full amount. So we're getting inventory, so we will debit inventory for $100,000, and it's on account, or it gives us these credit terms. So if you're given credit terms, it means that you purchased on account. So we will credit accounts payable also for the full $100,000. Okay, so that's recording the purchase. Next, the thing that happens is on July 12th, we return damaged goods of $12,500. So we're returning these, we're giving the goods back, and we are getting a reduction in what we need to pay. So for return, you debit accounts payable because we're no longer going to have to pay this full amount. So we debit it for the $12,500, which was what we returned, and credit inventory. We gave these items back, therefore we need to decrease the amount of inventory that we have. So we're never going to have to pay them, decrease AP, and we got rid of those items, so credit inventory. Okay, part C says that Toys Plus, that's the same example. So now there's a payment on July 15th, 2020. Again, whenever we have credit terms, first thing you ask yourself, did we pay within the discount date? So the original purchase was on the 8th, and we had 15 days. So a 2% discount available if we pay within 15 days. So 15 plus 8 is 23. So we had until the 24th, I guess, because it would be from this discount date. So we're paying on the 15th, which is only 7 days later. So yes, we are in fact paying within this 15-day discount period. So we will receive a discount on this. But we also need to ask ourselves how much is due. So we purchased on the 8th, but then we also returned some of these goods on the 12th. So we need to know from our little T account, our original purchase was $100,000. We returned $12,500. Therefore, we're left with $87,500 still owing. So that's the amount of accounts payable that we get rid of. Debit accounts payable for $87,500. We're paying within that discount period, so we will receive this 2% discount. So we can multiply this amount by 2%. If we do the math, we get $1,750. Since we received this discount, our inventory actually cost us less. So we credit inventory for $1,750. And we're paying this invoice off, so cash is going out. So we'll credit cash. Move this over to show it as a credit. and we take the 87,500, subtract our discount of $1,750, and we end up paying cash of $85,750. That is the amount that's paid within the discount period. Now, part D of this question says, in the end, how much did the inventory actually cost? So we can track all of the transactions that happened in the inventory account. Because under the perpetual system, we're always updating inventory so that we know the up-to-date cost and what we have. So the original purchase on the 8th was $100,000. So we debited inventory for that amount. That was this first entry. Then we returned some. When we did that, we credited inventory for $12,500. And then we received the discount when we made the payment within that shortened discount period. So we also had the credit here for $1,750. So overall, if we do the math here, 100,000 minus 12,500 minus 1,750, we're left with 85,750, which is equal to the cash that we paid, which makes sense. So overall, whatever you pay in the end for this inventory, that is how much it ends up costing you. So the amount we can see is our cash payment in part C. It makes sense that that is the ending cost that we also show in our inventory account.